Welcome to my channel Quant Finance. Today we are diving into a topic that's both historical and incredibly relevant to what's happening right now, 1929 versus 2024, similarities and lessons to be learned. As we look at the financial landscape today, it is hard not to draw some parallels with the events leading up to the Great Depression in 1929. So let us break this down by looking at three key areas: too much credit card debt, borrowing for real estate, and the overheating of the stock market, including the trend of margin trading. And then I will connect the dots to show how these issues are playing out in the current context. First up, let's talk about credit card debt. Back in the 1920s, easy credit was one of the big drivers of economic growth and its eventual downfall. People were buying everything on credit, from household goods to stocks, without really thinking about how they would pay it all back. Fast forward to 2024, and we are seeing a similar trend. Credit card debt has skyrocketed as people continue to spend beyond their means, often relying on credit to maintain a certain lifestyle. And while it might seem manageable in the short term, too much debt can quickly become a heavy burden, especially if interest rates rise or if there is a downturn in the economy. It makes sense, right? The more debt you carry, the more vulnerable you are when things go south. Next, let's move on to real estate borrowing. In the lead up to the 1929 crash, people were heavily borrowing to buy real estate, driven by the belief that property values would keep going up forever. Sound familiar? In 2024, we are seeing a similar scenario where low interest rates have fueled a real estate boom, with people taking on massive mortgages, often with little thought to what might happen if property values drop. The danger here is that if the market cools down or if interest rates rise, many people could find themselves underwater, owing more on their mortgages than their homes are worth. It is like walking a tightrope without a safety net. One wrong move and you are in trouble. Finally, let's talk about the stock market and margin trading. In the 1920s, the stock market was on fire and everyone wanted in. People were borrowing money to buy stocks, betting that the market would keep climbing. This is what we call margin trading, essentially buying stocks with borrowed money. But when the market started to falter, those same people were forced to sell their stocks at a loss to cover their debts, which only accelerated the market's decline. Fast forward to today, and we are seeing similar behavior. The stock market has been booming, and margin trading is once again on the rise. The risk here is that if the market takes a downturn, those who have borrowed heavily to invest could face significant losses, which could have a ripple effect across the entire market. So, what lessons can we learn from these similarities between 1929 and 2024? Well, for one, it is a reminder that history tends to repeat itself, especially when it comes to financial markets. The key takeaway here is that while borrowing can be a powerful tool for growth, it also comes with significant risks. Risks that can be magnified during times of economic uncertainty. Whether it is credit card debt, real estate borrowing, or margin trading, the common thread is that too much leverage can leave you vulnerable when the economy turns. And that is why it is so important to stay informed, to understand the risks, and to make smart, measured decisions when it comes to your finances. So, if you found this discussion helpful, do not forget to subscribe and stay tuned to Quant Finance, where we explore the connections between history, market trends, and what it all means for you in today's world. Thanks for joining, and I will see you next time.